Concrete is responsible for modern civilization.
But this essential construction material has fell victim to pockets of shortages across the U.S.
Such a process just to lay a concrete slab.
The copper market becomes a barometer for global economic growth.
An electric vehicle, solar, wind farms. As we move to a decarbonized economy, we're replacing C in the periodic table with Cu.
A boom in steel demand.
Demand is relentless.
I think people feel like steel is just, price can go higher.
I've been looking at this as the second biggest impact to steelmakers ever.
I get orders that sometimes I can't even keep up with.
Demand for paint materials soared over the pandemic.
Dealing with shipping problems and driver shortages.
A lot of times one drum might be the thing that you're waiting on that's the difference in making thousands of gallons or not making anything at all.
Concrete is the foundation of just about everything.
Concrete is responsible for modern civilization. I mean, to be blunt.
You walk on a concrete sidewalk.
Dean Martin planted his feet on the specially prepared concrete.
When you travel, your aircraft lands on a concrete runway. Drinking water is provided through concrete pipes. Not to mention what we know as concrete jungles, cities. In fact, concrete is so popular that it's the most widely used man-made product on Earth. For every person in the world, about 3 tons of concrete gets used every year.
It's been a very durable, sustainable, resilient material for thousands of years.
After all, it was essentially concrete that built Rome those thousands of years ago. To make concrete, we need cement first. The two materials are inherently tied together, but they're entirely different products. But this essential construction material has fell victim to pockets of shortages across the U.S.
The cement itself is becoming more and more difficult to get.
We're not unlike many industries. COVID caused disruptions in supply.
Now, demand is expected to increase. The global cement market could be worth over $458 billion in 2028. As more millennials buy their first homes, and after the Senate passed a major $1 trillion infrastructure package.
I believe it's a historic investment in roads and rail and transit and bridges.
All of which need a ton of concrete.
We don't have enough workers, ingredients, capacity to deal with the demand right now just coming out of the private sector.
At the same time, this kind of production emits a significant amount of carbon dioxide. One study estimates that global cement production accounts for 8% of global CO2 emissions. That makes it the largest single industrial emitter of carbon dioxide. Here's how the cement concrete supply chain works, and whether it can handle the demand from the new $1 trillion infrastructure spending plan. Demand for concrete rises along with construction activity. In 2019, 70% to 75% of U.S. cement sales were to ready-mix concrete producers, which was worth at least $65 billion. First, it's important we point out the difference between cement and concrete. Cement is like the egg of the concrete recipe.
So concrete is produced when cement makes a paste with water, and that's joined with rock and sand to harden. So concrete is more of a value-added product.
There are many different recipes for cement, but the most common one is for Portland cement.
There are different types of cement. One that's cheapest to make and is most prevalent is gray Portland cement. Called Portland because it's named after the gray stone on the Isle of Portland, England.
The first step to making Portland cement is getting all the ingredients, or raw materials, mainly rocks.
4 primary ingredients: calcium, silica, alumina, and iron. These are the most common elements in the Earth's crust.
Calcium is the main ingredient, calcium carbonate, aka limestone.
The process of making cement is still the same today. You have to get raw material. You got to get raw material from a quarry.
Cement companies own quarry space, where they use explosives to break apart the earth to find the right minerals needed. This quarry here is part of Lehigh Cement's operations in Union Bridge, Maryland. It's expected to have about 80 to 100 years worth of limestone. All the raw materials get crushed together into a powder.
And then after it's ground and crushed, they put it in a rotary kiln.
That kiln heats up to
typically about 2,800 degrees Fahrenheit. And by the way, that's about a quarter of the surface temperature of the sun. So it's really, really hot. And because it's so hot, we have these really complex chemical reactions that are taking place.
After the crushed rock cooks in the kiln,
it turns into material called clinker.
Then the clinker gets ground up again into a powder. This time materials like gypsum are added into the mixture. And then
it becomes cement. The process is still the same.
Well, it's pretty much the same. The U.S. cement industry has a rich history.
American industry shows the impossible accomplished. Almost overnight, the world's largest cement plant rises.
These early U.S. cement manufacturers helped build the Holland Tunnel, the Empire State Building, Rockefeller Center, and
The Panama Canal came true when America...
a project that changed global trade as we know it today. Now cement production occurs in 37 states, making the industry super local, which is part of the supply chain problem now. When the coronavirus pandemic struck in 2020, the U.S. economy came to an abrupt halt. The cement industry wanted to prepare for the coming recession. The last recession, after the 2008 financial crisis, caught the industry off guard.
It's like they expected to have big shutdowns because of what happened 10, 12 years ago, 2008, 2009. All of us expected the same thing to happen, demand fall off a cliff, and that didn't occur.
This affected supply levels, which is why the industry isn't seeing cement volumes it normally would right now, causing that supply tightness in local markets across the U.S. Sullivan says the cement market still grew by 2% overall in 2020.
And a lot of that growth came at the very end of the year.
Like Lehigh Cement in Union Bridge, they're sold out for at least the rest of the year. Another pandemic issue, the ongoing labor shortage.
It's such a process just to lay a concrete slab. That's human beings, and there's not enough of them that do that kind of work. And the hotter the market, the greater the increase in prices.
It's hard to find truck drivers who move the product around locally.
We rely upon trucks to deliver the cement from the plant to our terminals. I think 97% of all our product flows by trucks.
The red-hot housing market in the U.S. during the pandemic increased demand for concrete.
Instances in which supply is unable to keep up with demand, what that leads to is bidding wars. People are competing for concrete slabs to lay foundations, and that raises the price of those kinds of things. Like, not just for foundation building, but also for things like patios and driveways and so on and so forth. So lots of demand out there, supply chain disruptions, higher prices, big inflation numbers, frustrated home buyers.
Plus, weather events and cyber attacks can shut down production. Another reason the industry sees delays. These current supply chain kinks will work out in the coming months if economies continue to reopen at the same pace. And as of now, it's predicted that the U.S. has the capacity to manufacture the cement it needs. Assuming imports of chemicals and ingredients arrive on time, drivers and laborers are hired, and that extreme weather events don't shut down production, and that there aren't any COVID-related shutdowns. Of course, that demand will increase even further thanks to the infrastructure deal.
We have ample capacity to meet even the most robust infrastructure bill. You've got to identify what projects. You've got to identify the suppliers of those projects. You've got to do bids and reviews, and it takes time.
But you also have to look at it with carbon emissions. What happens through the life cycle of that product? How's it produced? How's it used? And what happens when it ends?
Cement production also comes at an environmental cost.
There is some positive correlation between economic activity and our greenhouse gas footprint. To the extent that demand is higher, the industry is more active, you would tend to see more carbon released in the air.
But we're looking at carbon neutrality throughout our entire value chain and reaching that by the year 2050. Our value chain isn't just cement or concrete, or for that matter, what happens at a cement plant. From a material science standpoint, that concrete absorbs CO2. Now, it's not a game changer, but right now we estimate about 10% of the CO2 emitted during the manufacture of cement and concrete is actually reabsorbed through the lifespan of a concrete structure. And when a concrete structure is demolished, we can reuse that aggregate for new concrete.
The prospect of more climate-friendly cement has attracted big-name investors. Breakthrough Energy Ventures, which is backed by Bill Gates, Jeff Bezos, Richard Branson, and other high-profile investors, recently invested 2.5 million euros in EcoCem materials to roll out new formulations of environmentally friendly cement.
I think it's going to be two key issues. One is green and everything that surrounds it on the product side as well as on the production side. And the second one is the infrastructure bill.
Even without the pandemic-driven labor shortage, the industry needs to train more workers to make up for retirements in the already shrinking labor pool.
So as an economist who wants to see a larger U.S. economy, a more efficient U.S. economy, one that has more infrastructure available to its people, it's frustrating to see so few young Americans in particular enter the skilled trades. And that's, again, one of the reasons that we have these shortages of infrastructure, these very high prices. So in the long term, I suspect we will have enough cement. But in the short term, we continue to have these supply chain difficulties, particularly in certain markets. And so prices are rising. And so right now, apparently, supply is not rising up to meet demand. The capacity is not there. I still think that we're going to be facing shortages and high prices through the balance of the year, but you'll start to see a better equilibrium form over the course of this year and then into next year.
This is a chart showing the price of copper, or, well, the price of copper futures contracts at the New York Mercantile Exchange over the past 2 decades. Let's zoom in on 2021. All year, copper prices have been surging, just a straight shot higher.
Copper up more than 30% this year.
Well, demand for copper has dramatically increased.
But I'm talking about the fundamental story for copper is a long-term, very positive one.
Let's zoom back out. See that big dip in 2008 going into 2009?
The last time copper prices got high, just before the financial crisis in 2008, 2009, people were stealing copper wires out of homes that were being constructed. They were going into other buildings and ripping out plumbing pipes and copper wire.
Copper has played a big role in the world economy for thousands of years. The Bronze Age? That happened because blacksmiths figured out how to forge copper with tin. Now, copper is used in electrical and heating equipment because its chemical properties make it such a useful conductor. It's used in car motors, household pipes, washing machines, all sorts of things we use every day. That's not to mention all the different copper alloys that get mixed into other metals and items. Also, the metal is so easily recyclable that most of the copper on Earth remains in the ground. In fact, only about 12% of all copper on Earth has been mined throughout human history, and nearly all of it remains in circulation. Some copper in circulation right now could have once been jewelry or armor in ancient Egypt. So why are smart people like commodity analysts at Goldman Sachs warning about a copper shortage, with dire consequences for the world economy? In May 2021, investment bank Goldman Sachs released a note calling copper the new oil. More importantly, the bank said copper prices could double in the next few years, jumping from just over $9,000 per ton to $20,000 per ton by 2025.
Copper is the single best conductor of electricity known to physics as well as the periodic table. So if we're going to electrify the world and decarbonize that way, we absolutely need copper to do it.
I agree with that. The tenor of those reports was that higher prices would have to incentivize new supply. And the tenor was that if that doesn't happen, we would have a copper shortage in the future. But it's not that we have a copper shortage currently.
Wall Street basically thinks copper could play a huge role in 2 major trends: electric vehicles and decarbonization. At the same time, there's not enough copper getting mined from underground deposits or coming from scrapyards to feed the coming demand.
The industry cannot continue to do what it has previously, or else there really is going to be a severe copper shortage as soon as all these big car companies start making more electric vehicles, it will happen like a light switch. We'll see that there's a copper shortage.
So the so-called shortage isn't the world running out of copper, it's more about the current mining and recycling infrastructure not being able to meet a potential boom in demand.
I would, on a longer-term cyclical view, think that this is actually a great opportunity to position oneself for a long-term copper bull market. Why? Because of these demand drivers going forward. And the biggest demand driver going forward over the next decade is green tech.
When you have further electrification, you need more wiring, you need more electrical components that conduct electricity and make these things run. Copper's critical to that. And so people are just starting to realize just the magnitude of copper's presence throughout the economy.
For a while now, commodities traders and economists have had a special nickname for copper.
Well, they call him Dr. Copper for a reason.
Well, Dr. Copper is saying that we are going to go and test those lows.
We tend to call it Dr. Copper because people tease it has a PhD in economics.
So when economic activity increases, the demand for copper increases, and then copper prices increase. In that sense, the copper market becomes a barometer for global economic growth, a leading indicator. Dr. Copper doesn't always provide a surefire diagnosis. Sometimes the connection between copper prices and economic growth breaks down. Copper is important for a lot of different local economies as well. Where does copper come from?
You know, in the last 50 years or so, South America has become very important. Peru and Chile really dominating the copper supply there. Arizona is the leading copper producer in the United States. And if Arizona was a country, it would probably be 5th or 6th on the list in terms of top producers. Zambia in Africa has a very significant copper belt. There's a huge mine in Mongolia. So I would say, basically, if you think about the Pacific Rim, as you come down the western United States and through the Andes, that region has a lot of copper. And then if you go over to the Asia side of the Pacific Basin, then you're going to pick it up through Papua New Guinea, up into Mongolia and Indonesia. So kind of the whole Pacific Basin, and then some in Southern Africa.
The copper industry is bracing for a boom in demand. Governments and companies around the world are preparing for a green energy revolution. Entirely new power grids using solar, wind, and water to power turbines and feed electricity into copper wires. What's more, electric cars need much more copper than their gas-powered counterparts.
A typical gas-powered car have about 50 pounds of copper, but an electric vehicle is more like 184 pounds of copper, 3.5 times more copper, because you have more motors in the batteries in an electric vehicle, more electronics. Solar, similarly. Conventional energy, normally you think about 1 metric ton of copper per megawatt of generating capacity. Renewable energies are 4 to 6 times that amount of copper. Solar installation could be something like 9,000 pounds per megawatt. Wind farms could be as much as 15 million pounds of copper. An individual wind turbines about 800 pounds. So as we move to a decarbonized economy, we're replacing C in the periodic table with Cu.
Higher copper prices may have a silver lining. They'll cause mining companies to break ground on more new projects, since extracting copper will have a bigger payoff. There's also new technologies springing up to extract copper, like Atwin's company, Jetty.
Jetty unlocks fast stranded copper resources. We do that using a catalytic technology that was developed in partnership with the University of British Columbia with the intention of breaking the sulfur metal bond that exists in copper ores. For many decades, there's been an issue that the copper mining industry has been trying to solve for, which is oftentimes called the Holy Grail. And that's being able to use hydrometallurgy, the use of solutions, getting them in contact with copper ore, and being able to extract copper from low-grade material. Because there's a huge amount of copper that's stuck in low-grade material at copper mines, which historically was thought of as waste. Jetty specifically operates in the hydrometallurgy realm. We produce copper cathode. That comes from leaching at big copper operations. Leaching uses 2 to 3 times less water than traditional extraction methods, has a much lower emissions profile, and the industry has an interest in producing more copper in that manner, greener copper.
The boom in copper demand is just the beginning. Mining companies will have to strike a delicate balance. Rising copper prices means there's more demand for mining projects. If prices get too high, like astronomically high, companies could look for alternative metals for their green energy projects. At the same time, more copper mining means more of the metal enters the economy, which could bring prices lower, leading to fewer mining projects and back down to the current situation: tight supply, high demand.
Steel is essential. It's in everything. Think appliances like dishwashers and dryers and fridges and microwaves, or even air conditioners, not to mention planes, trains, and automobiles. And
every type of manufacturing, from machinery, needs steel to build windmills, solar panel systems, certainly to build out the electricity grid.
When the pandemic threw supply chains into chaos, steel was no exception. Prices dropped, then popped.
A boom in steel demand.
Demand is relentless.
I think people feel like steel is just, price can go higher.
I've been looking at this as probably the second biggest impact to steelmakers ever. And I think that the largest impact is World War II.
Impending steel shortages become a major problem as America's war production streamlines into high.
Steel prices spiked 300% over pre-pandemic levels, at one point pricing over $1,900. That's up from steel's pre-pandemic price range between $500 and $800.
They have turned into a bubble, and that bubble is they just go higher because they go higher. We should see prices move back probably in a pretty violent manner.
Is that the bubble popping?
Yes, yep.
Steel is one of those categories in which prices have really risen dramatically. Steel is certainly one of those examples of shortages, higher prices, growing frustration among customers.
Plus, steel remains a key material in infrastructure projects. So the Biden administration's plan to inject billions into U.S. infrastructure will be a huge boon to the steel manufacturers.
We estimate that for every $100 billion of new investment in infrastructure, that's going to mean 5 million tons of additional steel demand.
2021 steel demand is expected to increase 3.8% over 2020, according to the World Steel Association. Can the U.S. steel industry keep up with demand? And what happens when that bubble pops? Steel can be manufactured in two ways. First, there's the integrated method. In the simplest terms, you mine iron ore, you smelt the ore in a blast furnace with additional materials like coke, a form of processed coal, and limestone, and then you've made steel. But
in the United States today, we actually make 70% of our steel using a different method, which is what we, in the industry, we call the electric arc furnace route.
It's a way of melting down old steel, scrap steel, into brand new steel.
Previously produced steel, old car bodies, refrigerators, steel that was in old buildings, and that is shredded and melted down.
Other alloys are added in, like some new iron ore, and then the furnace is tipped to pour out the molten steel.
When it comes to clean steel, the U.S. certainly is leading the way.
But there is work yet to be done to make U.S. steel production emit less carbon. Two of the U.S.'s biggest steel companies, Nucor and Steel Dynamics, both use electric arc furnaces, or EAFs.
If you think about the EAF furnaces, the Nucors and the Steel Dynamics, they have very competitive cost structures. They're very flexible in cost. They have a history of really good financial performance. And certainly their stock has increased throughout all of this because higher prices have led to higher margins, which leads to higher earnings.
But
their stock hasn't moved as much as some of the other ones. Cleveland-Cliffs,
a purveyor of the integrated method, but they have some EAF mills too, and there's U.S. Steel.
The people that have moved the most, though, has been Cleveland-Cliffs and U.S. Steel. The market has been very challenging. It's been very competitive, and they've had to take on an increasing amount of debt leading up to the pandemic just to continue on. And then because of this structural change in the market, these mills earning excessive to historical norm margins, they've been able to pay down debt, pay off debt, buy back billions of dollars of shares. So the steel mills really are a different company today than they were 2 years ago.
Steel prices are good, and they will continue to be strong. It's all about demand.
we have limited supply, and people want things done right now. So that creates competition. That's the basis of capitalism. We'll continue to work to reward our shareholders and to generate the cash that is necessary to reinvest in our business.
The coronavirus pandemic definitely had an impact on the steel industry. Now, steel producers were generally identified as essential industries, so they weren't shut down by any government action. But many of our customers saw big drops in demand. For instance, the auto industry, which buys maybe 25, 26% of all the steel produced in the United States every year, largely shut down in the spring of 2020. And a lot of construction projects were slowed, everything. So demand for steel dropped precipitously between the middle of March and May. So much so that steel producers in the US, responding to that market signal, did reduce production dramatically. We had a number of steel mills that shut down altogether.
Steel production went way down and inventories depleted. And then demand started picking back up.
So we've seen a huge increase in demand. So much so that, steel production today is up 60% over where it was at the low point back in May of 2020.
The economy began gaining steam in late 2020 as vaccines began to roll out.
We have seen with this pandemic, locking things down and coming out of the lockdown, was that there truly was a shortage. Buyers could not get as much steel as they required just for normal operations. Outside of, nobody was able to hoard steel, nobody was able to build any inventories because the mills were limited in terms of how much of each contract they could satisfy, and they were selling much less than their contractual volumes just because of this shortage.
And then when demand came roaring back, distributors were caught short, and everyone started ordering steel at the same time, and it does take some time to make that steel. So our plants started coming back as quickly as they could.
The U.S. also imports a ton of steel.
China is easily the world's leading manufacturer of steel, so we import a lot of that, and we benefit from those low prices. But again, those tariffs have been in place, and that causes prices to rise. I'm not saying those tariffs are a good thing or a bad thing. I'm simply saying that they would tend to drive up price, and they have done that.
The U.S. is the world's largest net importer of steel. Steel imports are up 17.5% year to date as of August 2021. The U.S. imported more than 16 million metric tons of steel so far in 2021, as of July. But depending on which country these imports come from, there's a tax on the steel imports, aka tariffs.
In 2018, the president imposed across-the-board steel tariffs as a national security measure because the concern was that the levels of imports coming in were undermining the viability of the industry over the long term.
President Trump said the increasing imports posed a threat that could drive U.S. producers out of business, leaving the country dependent on foreign suppliers. Then he exempted big trading partners, Canada and Mexico, from these tariffs.
When the Trump administration first started to implement those tariff increases, there was a big squeeze on domestic steel. So all of a sudden, people said, I don't want to pay those tariffs. I want U.S. manufactured steel. And part of that was because there was this notion of let's buy American, let's produce more here. But what happened, of course, when foreign steel prices go up, domestic steel prices go up. Steel prices were rising significantly during much of the Trump administration, and of course the pandemic.
Customers buying steel felt the impact of both the high prices and tariffs. On the flip side,
I will say the one good piece of news is because we had those steel tariffs in place in 2020, the COVID-19 crisis could have been another demand shock, very similar to what happened in the late 1990s or in 2008, 2009. And we could have seen a new surge in imports because when imports come in at very high levels, they tend to undercut domestic producers. They often sell at a loss in this market, what's called dumping.
Dumping is when other firms or countries come into another country's market and dump products at artificially low prices.
We put tariffs on all the crap that they were dumping from China, 25%. They were dumping the steel, and we said, you can't do that.
So dumping makes it hard for U.S. manufacturers to run mills at a profit.
But because we had those tariffs in place, that didn't happen. And so the industry remained healthy, was able to recover, continue its investment, and be in a strong position to meet the growing demand that we see today. You want to be running your steel mill as close to full as you can to really cover those fixed costs. Suppose you really want to be running at least 85% capacity utilization, which is where we are today. But back in those years before the steel tariffs were imposed, we were running only in the low 70% range. And that was really an unsustainable level for us. And that was because of the high level of imports coming in those years.
Tariffs also created an environment that incentivized the U.S. industry to invest in its facilities.
We've spent close to $16 billion just since 2018 in investments in new facilities and upgrading existing facilities.
We do have a pretty substantial amount of new capacity that's coming online that was in planning to be built for the past few years. They're coming online in Texas and Kentucky and in Toledo, Ohio. As that comes online, we expect prices to move back towards a more historic norm. I think what really comes next is the mills are going to be earning incredible profits this year, most of next year.
We have already made in revenues more than $9 billion this year in 6 months. Infrastructure bill will be an icing on the cake.
And I think what's next really is how are they going to be investing those profits? What are they doing with it?
For a long time was to continue and invest in the down cycles to create higher highs and higher lows. So the mills that are coming up online now are benefiting from that.
As for steel prices in the U.S.,
there's a supply deficit that's supported prices, and that supply deficit is easing and going away. And as that happens, we should see prices move back probably in a pretty violent manner, at least in the start, maybe a 15 to 20% drop in a matter of a month. And as that happens, prices will then be on their trend line down back towards more historic levels.
Is that the bubble popping?
Yes. Yep. We see prices peaking here in the it should be in this half of this year.
So I don't know that I would say that we're in a bubble that's going to be burst. I think we're going to see continued strong demand.
The good news is that steel supply capacity will rise over time. The cure for high prices is high prices. So when steel prices are high, that creates an incentive for suppliers to increase output and eventually capacity. I think you're going to see that happen. And so we hopefully will see lower prices at some point in the future, even as the world continues to use more steel.
Can you guess what color of paint this is about to be? Green? Blue?
There's color all around us that we do take for granted. We look at every single day, don't appreciate. And that all came from just the correct amount of color pigments into a gallon of paint, basically chemistry in a gallon.
The color economy touches nearly everything.
And so no matter what you buy, it's got a coating on it.
But right now, paint may be harder to come by.
And so there is a shortage.
Or at the very least, more expensive. It's due to a confluence of factors.
It's kind of a whack-a-mole. Something goes wrong, it gets sorted out, and something else happens.
It takes specific pigments and access to global trade networks to move color around the world.
Who has the pigments to create that product?
Color pigments is large. There are hundreds. Ultimately, there were thousands.
That makes paint vulnerable to supply chain issues and climate change. Two of the largest paint companies, Sherwin-Williams and PPG, have cited worsening supply chain shortages impacting their ability to manufacture product. Meanwhile, home improvement retailers like Lowe's and Home Depot have seen earnings soar as customers spend money on fixing up their homes.
Our sales have actually gone up pretty substantially.
How long the disruptions will last is a matter of debate. So why can't businesses and consumers find the colors they need to paint the world as we know it? There's a lot of different kinds of paints and coatings, but no matter what, it starts with science.
Well, my name is Tony Pellicino. I am the owner of Tonester Paints here in Orlando, Florida.
He fell in love with mixing paint during his part-time job while still in college.
Today, let's make a brand new paint color.
He brought that love of color to TikTok.
It falls into that oddly satisfying category. The cool part about paint colors is that it's measured very precisely of how much pigment is in each gallon to achieve a certain color. To make a gallon of paint the exact same as the next one, you have to have that same amount of color pigment in it.
As the industry began to progress through the age of industrialization, synthetic materials made from oil and natural gas came into play based on polymer resins. They outperform the organic materials in terms of durability, adhesion, chemical resistance, oil resistance, water resistance, and so that took over the market.
The paint shortage is mainly isolated to synthetic paint.
It is quite a fragmented market. The biggest part of the market is decorative architectural, residential and non-residential paint, interior, exterior. Then you've got those coatings that are applied in a controlled environment, factory environment, automotive assembly plants, coatings that are applied on food containers and beverage containers. Third then are field applied coatings.
The main paint ingredients are the pigments, which provide the color and hue, resins for binding, solvent, and additives. Solvent or water holds the other ingredients, like the additives, and the additives vary, but can make paints fast drying or scuff resistant, things like that.
The largest ingredient is the resin. The second largest is the TiO2.
We'll call it the white pigment, titanium dioxide.
TiO2 is the most costly pigment, and it represents approximately 31% of all pigments used as coatings raw materials. Then pigments or colorants are added. As the modern color industry developed, so did the standards for producing colors. Swatches are used to communicate color accurately, so different companies can achieve the same colors.
At least subconsciously, the color is a language that explains something. I think from a brand point of view,
every color and color combination expresses something different.
I couldn't see Starbucks moving off of their green or Coca-Cola moving off of their red.
Thus, the standardization of color was born, like the color index. Another example is the Pantone color matching system, a standardized color reproduction system, and it has thousands of colors.
it's measured visually by expert color technicians, but it's also being measured spectrally, so scientifically. It has to be a clear standard, not a reference, a standard. That's what people expect from us, that kind of consistency, whether it's our cotton formats, our pigment formats, or our print formats.
Raw material shortage is still, it's something we have a meeting once a week to discuss, what are we kind of out of this week?
I get orders that sometimes I can't even keep up with.
Demand for paint materials soared over the pandemic as those quarantined took to DIY projects and home improvement. But supply couldn't keep up with that demand during the setbacks COVID caused manufacturers. Not to mention shipping.
Dealing with shipping problems and driver shortages and dealing with containers not being able to come on shore and being offloaded, dealing with the Suez Canal blockage. It's a little different when you compare it to Walmart and Target because they're bringing in finished products. They're not bringing in intermediates and raw materials that have to be manufactured and produced here in the US.
Pigments are often imported from Asia.
The vast majority of colored pigments are produced in India and China. They're not produced here.
I do know that companies have been shipping raw materials by air freight to meet the customer demand.
We have been flying in things because we've had to. We're doing everything we can to protect our clients.
Another incident that affected the industry.
LyondellBasell, which is a major supplier of acetic acid, a precursor to the vinyl resins that go into interior paint. They had a major accident, but it took down a major unit that supplied product globally. And so the entire global supply chain felt that accident.
Climate change has also impacted production. In a statement to CNBC, paint manufacturer PPG said a number of global suppliers have been impacted by disruptions due to weather events in 2021, as well as recent Hurricane Ida impacts. The deep freeze in the South slowed production of petroleum and plastics in 2021. That impacted a critical ingredient for all kinds of paints and coatings, resin.
The ice storm hit inventory was extremely low because of COVID.
A lot of times our roadblock will not be the bulk of resin that's going in there, the pigment, it'll be the one thickener in there, but you need it to make paint, right? And so that one drum might be the thing that you're waiting on, that's the difference in making thousands of gallons or not making anything at all.
The whole thing about this raw material shortage is that things come in waves, right? Sometimes you'll have an abundance of certain materials, products, and other times that's not so much the case.
All of these impacts reach both consumer and business wallets.
We have seen price increases. We are absorbing pretty much all of that. We just want to protect our customers. At the same time, I don't know how you don't, in some ways, pass it on to the consumer.
Actually got a couple of price increases again today, so those are still kind of rolling in. We're hearing some stabilization in the second half of 2022, but I don't think that means prices are going to decline.
Inflation at the consumer level is definitely one way that the consumer is seeing this. The second is having enough product available.
Sherwin-Williams told CNBC in a statement, production disruptions coupled with surging architectural and industrial demand have pressured raw material supply and rapidly driven prices upward. Sherwin-Williams is the largest paint manufacturer in the U.S. with $18.4 billion in annual revenue. Meanwhile, PPG told CNBC in a statement that it continues to take an aggressive approach to securing materials and carriers to minimize the impact to our customers.
Price increases have been coming at them left and right. Almost every month, every 2 months, significant price increases across the board in all of the major chemical categories.
Producer prices for painting and coating manufacturing rose 15.7% in December 2021 from a year ago. Meanwhile, on a 12-month basis, the producer price index overall was up 9.7% to end 2021. The highest calendar year increase ever in data going back to 2010. At the same time, sales totals have been rising. Sales at paint and wallpaper stores spiked 7.8% annually in June 2021 to $1.34 billion. The pace of sale increases has slowed but is nevertheless robust. For example, the latest data available in November 2021 shows $1.1 billion in sales. Paint could continue to be scarce and costly for the foreseeable future.
I do think most companies are very, very thoughtful and they want to keep their clients. At the same time, costs do rise and they also need to be profitable.
If nothing else happens in the chemical supply chain, today we're forecasting fourth quarter of 2022 and possibly into the first quarter of 2023 before we see some sort of normal. But the industry has resilience. The industry has good people. We will get through it.
As many negatives there have been about everything that's gone over the last year with supply chain and everything, it has opened people's eyes to alternatives. You know, when these giant corporations don't have product or their shelves are bare or something, there's other people to shop from out there. You know, there's smaller family-owned businesses like we are.